Hey there, this is Seth, and today we're going to talk about the seller's advantage in a seller-financed transaction. So this is all about structuring loan terms that put the seller in control. This is very important to pay attention to if you are the seller in a seller-financed deal. We're going to talk about all the most important things you can do to stack the cards in your favor and make sure that the loan documents are written to protect you and give you the most options on how to pivot in the future if you ever need to. So when you sell a property with owner financing, one of the biggest advantages for you as the seller is that you can dictate and control a lot of the terms and conditions of the loan that you set up. And this is a huge benefit, but only if you know how to wield this kind of power and what options you have on the table. So before we get too much further, let's just step back and acknowledge something. When you give your buyers the option to purchase your property with seller financing, you are doing them a huge favor. This allows them to sidestep a lot of the time-wasting and sometimes deal-killing red tape that every bank forces their borrowers to go through. And sometimes seller financing is the borrower's only option because their bank doesn't like the property or doesn't like something about the borrower. And on the flip side, there are other times when buyers will take you up on seller financing and choose to buy your property from you that way, even if they have the money or even if they have access to a bank loan. And the main reason they would do this is simply because they don't want to deal with banks or some issue that the bank is making an issue for them. And don't get me wrong, working with a bank certainly has its advantages too. Banks will typically charge a lower interest rate and almost always allow for a longer amortization on their loans with no balloon payments. For all you non-finance nerds out there, it basically just means that they allow for a much longer term to pay off your loan, which results in a much lower monthly payment with no big surprises. So they don't just make you pay off the entire balance of the loan 3 or 5 years into the loan term. Banks have no problem letting their borrowers pay off loans over 15, 20, 25, 30 years, sometimes even longer, but most sellers, including you and me, are not going to want to wait this long to get their money back. So if you decide to offer this convenience of seller financing to your buyers, you'll want to know how to stack the cards in your favor so that you're compensated for the inconvenience of waiting longer to get your money. And it's not just about getting a large enough down payment and a high enough interest rate, although those are certainly huge parts of this. It's also about having control. And this comes down to what is written in the loan documents that you choose to use when you close this deal. So what terms can we include in our loan documents to keep ourselves in the best possible position if the borrower ever decides to pay late or just stop paying us altogether? Well, I'm going to go through a number of different terms you can include in your loan documents. And as always, this is not financial advice. This is not legal advice. These are just ideas that I think you should strongly consider to make sure you're keeping yourself in the best position. So run all of this stuff by your attorney or whoever is putting together your loan documents for you. So when we're drafting the remedies on default in our loan documents, from the seller's or the lender's perspective, the goal here is to create a set of tools that will give you the maximum control and flexibility to address any potential defaults if that borrower ever stops paying or pays late or does anything really to violate the terms of the loan agreement. So you'll want to make sure that if the worst case scenario occurs, you're going to be protected. So first up, late fees and default interest. So this is a standard provision in pretty much any loan document template, but in case it's not obvious, I'll point out that you can implement a higher interest rate and or late fees after a borrower defaults on their payments. This is a good motivation for the borrower to make timely payments and compensate you as the seller for any additional risk and costs associated with handling the default. Another thing you can include is what's called an acceleration clause. You can think of an acceleration clause as a safety net for the seller. It's like saying, hey borrower, if you don't follow the rules we agreed to, you'll have to pay off this entire loan right now. So here's how a seller can make a really strong safety net with the acceleration clause. First of all, by having really clear rules. The seller should clearly define what counts as quote-unquote breaking the rules, otherwise known as being in default. This could be simply not paying on time, or not keeping the property in good shape, or not paying for insurance and taxes, or anything else that you and the borrower agree on. Now, one quick warning here, if the borrower ever violates these rules, then you as the seller should give them a heads up and specify what exactly the problem is and how much time they have to fix things before you as the seller ask for all of your money back. And it's also important to ensure everything in your acceleration clause follows the law and that it's fair. Sometimes there are specific rules from state to state about how and when you can ask for all your money back. So be sure you have an attorney looking this part over for you, just like everything else we talk about here. But the beauty of an acceleration clause is that you as the seller can feel safer lending money and have a plan if things don't go as expected. It's all about making sure everyone knows the rules and what happens if those rules aren't followed. Now, another important thing to do is to define what the collateral is in this deal. A huge part of what keeps the seller or lender safe in a seller finance transaction is their collateral. The collateral is whatever the lender or the seller, again, that's you, whatever you can grab and take from the borrower if they stop paying. And in a lot of my seller finance deals, the collateral is simply the subject property, just the property that's being bought and sold between us. No more, no less. And if that borrower ever stops paying, the only way I can make myself whole is to get that property back. Or in some states, I would have to auction off that property. That means paying whatever costs, spending whatever time, and going through whatever channels were necessary to regain control of that property or get it auctioned off so I can hopefully make myself whole that way. And the tricky thing about collateral is that it's not just about what the collateral is worth. It's also a matter of how much time it will take, how much money it will cost, and how easy it's going to be to get that property back. Some states make this more difficult than others. And the key is to make sure the value of your collateral is more than enough to justify your efforts in taking it back. In other words, it should be worth well over the loan balance when you close on the loan. This is known as the loan to value ratio, or the LTV. This is a very important number in any kind of seller finance loan arrangement. For example, let's say I'm selling a 10-acre parcel for $50,000 and it's legitimately worth $50,000. And the borrower puts down $10,000 at closing, which means they now have a $40,000 loan. And in this situation, my loan to value ratio would be 80% because that $40,000 loan is 80% of the $50,000 value. And as the borrower continues making payments and as the loan balance gets lower, that LTV is also going to get lower because the loan amount is lower relative to the property's value. And as the seller or lender in the deal, this is good for you. A lower loan to value equals less risk. A higher loan to value equals more risk. So you don't want that loan to value to be that high. And the loan to value ratio can technically be whatever you're willing to accept, but an 80% loan to value ratio is a pretty good starting point for the average deal. The LTV could go higher if the borrower puts down less money, which means your loan balance would be higher relative to the value. And I would only ever do this myself if I thought the loan was really low risk, which meant, say, if my borrower was a doctor or somebody really wealthy with a really high credit score and they were a very low risk borrower, that might be one reason. Or alternatively, this loan to value could be lower, which means the borrower would have to put down more money at closing. And I would do this if I thought the loan was a higher risk. Say if I thought it was going to be a huge pain if I ever had to take this property back, or say if the borrower was questionable in their creditworthiness, if I didn't necessarily trust them that much, that would be a really solid reason to ask for a much higher down payment, giving me a lower loan to value up front. And there are some cases where taking additional collateral, also known as cross-collateralization, may make sense. For example, if the loan to value is very high, say 90, 100, or even 110%, which would be ridiculously high, this would normally just be way too high. But if you can take additional collateral from the borrower, whether it's another property they own or a piece of equipment they own, or just straight up cash from the borrower's bank account, if you can have a claim to that cash somewhere, then this additional value could help mitigate your risk. And that's what cross-collateralization is all about, is that you're not just taking the subject property, you're also taking that plus another property or another thing of value that could help shore up your collateral position and make it less risky for you, because that borrower now has more on the line. They have more that they stand to lose, and you have more that you stand to gain if they go into default and stop making their payments. And whatever collateral you want to attach to your loan, you'll want to be sure this is spelled out very clearly in your loan documents, just like anything else, so that you have the proper authority to access these assets if the borrower defaults on their loan. Now, another thing we can do to protect ourselves as the seller and keep us in control is to get the borrower's personal guarantee. And this is a very common requirement that banks ask for whenever you have to take out a commercial loan. Every commercial loan I ever closed in my old job as a commercial banker, we always took a personal guarantee. And when I've borrowed money to buy commercial properties, I've also had to sign a personal guarantee. And without a personal guarantee, if the borrower can't pay back the money, the lender can't ask the borrower to pay it back out of their own pocket. They're basically limited to whatever collateral they called out in their loan documents, whether that's just the subject property or any additional collateral they may have required. But if they didn't sign a personal guarantee, the lender can't go after them to get the money out of their own pocket. So if the borrower does sign that personal guarantee, that means the borrower is going out of their way to say, hey, lender, if my business can't pay, if I can't pay personally, I promise I will pay this back with my own money. And personal guarantees can be written in many different ways, with different levels of specificity and different levels of severity if that borrower stops paying. For example, there's something called an unconditional guarantee, which means that the borrower is promising to pay back that debt no matter what. There are no specific conditions that need to happen for this guarantee to be effective. If the debt isn't paid back, the guarantor must pay it with no ifs, ands, or buts about it. Now, another one is called a conditional guarantee. And in this case, the borrower's guarantee comes with certain conditions. The guarantor only has to pay if certain situations occur or if certain conditions are met. And if those conditions don't happen, then the lender can't come after the guarantor for anything beyond the project collateral. It's that simple. There's also something called the unlimited unsecured guarantee. And when I was in commercial banking, this was the most common type of guarantee that I saw. This type of guarantee means that the guarantor is responsible for paying back all amounts of the debt, and there's no limit to how much they could owe. However, unsecured means no assets, like for example, their primary residence or their car or a savings account. There are no assets specifically pledged to back up their promise. So if the debt isn't paid, the lender can seek repayment from the guarantor for the full amount, but they can't immediately seize assets because it's unsecured, and that borrower didn't pledge any assets when they signed the guarantee. And these different types of guarantees go on and on. I'm not going to bore you with that, but the point is, if you ever have any concerns over the risk of a deal, whether it's the borrower themselves or the specifics of the property, you always have the option as the lender to require the borrower to sign some kind of a personal guarantee. And in my experience, personal guarantees actually are not the norm with most seller finance deals. Like every time I've ever sold a property with seller financing, like a piece of land, I just take that subject property as the collateral and that's it. But that doesn't mean I couldn't ask for a personal guarantee. And it doesn't mean you can't ask for it either. Even though it's not the norm, it's just something worth being aware of. If you ever have issues or you need to mitigate the risk and make it less risky, this is one way you can help do that, is to include some kind of a personal guarantee in your loan documents and obviously make sure the borrower understands what they're signing when they sign it. And also keep in mind that a personal guarantee is only useful to the extent that the borrower actually has the financial strength and wherewithal to fulfill their personal guarantee. If they have absolutely no money to their name, then they can promise the whole world but be unable to fulfill their promise. So just keep in mind, if you go down this road, you'll want to also be sure you're doing your homework on this borrower to verify that they actually have some money to honor this promise that they're making you. And how can you do that? Well, one way is to get the past 2 years of their federal tax returns just to verify how much money they're making. You can also have them fill out a personal financial statement to verify that they have the financial means to pay up if needed. And if they pledge specific assets like other real estate, for example, you can get a schedule of the real estate that they own and verify that they actually have ownership over those assets that they're pledging. And if this all sounds like a lot of extra hassle to deal with, it's because it is. I'm not going to sugarcoat it. This is a lot of extra work and additional hoops you'll have to jump through before you can approve this borrower and get your loan closed. But this is what banks do all day long. They have entire departments dedicated to verifying this stuff because they're in the business of doing loans like this. And if you want to underwrite these things the best way, this is what it takes to do that. You're always welcome to skip these steps if you want to, or just not check these things. But just realize for each of these things that you don't check and verify, you're opening yourself up to more risk. And this is what loan underwriting is all about. Now, another thing you can do as the seller and lender to keep yourself in control of this deal is to give yourself the right to inspect the property. When you sell a property with owner financing, the property isn't truly out of your hands until that loan is paid in full. Regardless of what type of loan instrument you use, the subject property is a big part of what's going to protect you if the borrower decides to stop paying. And because of this, you need to make sure the property's value is actually maintained. One thing that can seriously undermine and diminish a property's value is if the property gets trashed or destroyed or tarnished in some way. And this can be a huge issue with properties with buildings on them because buildings will fall apart all by themselves over time. It takes some serious effort and money to keep any building in good working order. And even with vacant land, this can be an issue, believe it or not. For example, if a property is desirable because of its trees, and then all of a sudden the borrower decides to cut all those trees down, that can have a very material negative impact on the property's value and the lender's ability to resell it quickly if they ever need to. So even though vacant land is a much simpler type of property, it can definitely still be affected if the borrower leaves trash or broken down vehicles on the property or alters it in some way. So to ensure your borrower isn't destroying your property's value, it's important to include a clause that allows you to periodically inspect the property if necessary. And when I deal with vacant land, this is pretty easy because any inspection can usually be done just with a drive-by. But with houses or buildings on the property, the lender will want the ability to actually get into the property if needed. Now, along the same vein of protecting the value of the subject property, it's also important to specify what the borrower is not allowed to do with your collateral. And this can be a significant issue with vacant land properties because if you don't specify what they can't do, the borrower could start taking down trees or defacing the property or building some monstrosity without a permit that could seriously damage your property's resale value. And because of this, I include a couple of clauses in my loan documents that say that, first of all, the borrower promises to not alter the property by removing timber or excavating the soil or installing or removing any septic or well systems, etc., in any way without my written consent as the seller and lender. And it also says that the borrower promises to maintain and use the property following all applicable use restrictions. So this means the borrower pretty much can't do anything to the property until they pay me off. And if this is a problem for the borrower, they can overcome it pretty easily by just paying off the loan, whether they cough up their own cash or refinance it with a bank. And once the property is in their name and once I have my money, then they are free to do whatever they want to do with that property and deal with the consequences. Now, another important thing to do to keep ourselves in control is to specify who is going to pay the property taxes and the insurance on this property. And depending on the borrower, depending on the property, depending on the annual cost of taxes and insurance, it's usually a good idea to make sure the borrower is covering these costs. And this should be spelled out very clearly in your loan documents. Again, just like everything else we're talking about here. However, in some cases, like with vacant land, the cost of property taxes can be very, very low. And property insurance, if you have it at all, is usually very inexpensive. And in these cases, I could pretty easily just create an escrow account and add these annualized costs to the borrower's monthly loan payment and then just make sure that these costs are paid myself. But however you choose to handle this, it should be very clear that the cost comes out of the borrower's pocket, not your pocket as the lender. Now, another important thing worth talking about here is an assignment and assumption clause. So depending on what your long-term strategy and plan is with seller financing, there may come a day when you grow tired of collecting small monthly payments and you just want to cash out and move on. If this day ever comes, you'll want to be sure that you have the borrower's permission to do this. And it's fairly common for mortgage originators, that's you as the seller who's the lender, to sell their loans to other investors. Banks and private loan originators like you and me do this all the time. And if you want more guidance on how this works, be sure to check out Module 6 of the Seller Financing Masterclass where we talk all about this. And also, don't miss the conversation I recorded with Eric Sharaga about how to set up each new loan so that you can sell it at the highest possible price. Again, this is also in the Seller Financing Masterclass. So if you want to have the option and the ability to eventually cash out, sell your note, and move on on if and when you want to, one crucial component you'll want to include in your loan documents is an assignment clause, which gives you the unqualified right to assign your rights in the note to a third party. And if you sell your note like this, you'll need to give the borrower a written notice to inform them about this change. But as long as this assignment clause is included in your original note, you're not going to have to ask their permission. You're just letting them know because they already gave you their permission because that assignment clause was in there. And after you've notified the borrower of this, it's pretty simple after that. The note investor who's buying your note from you will wire you the agreed upon price for the note, and they will simply step into your shoes as the lender, and they will collect the remainder of the payments and take on whatever risk is associated with that deal. But again, it all starts with including the appropriate clause in your contract to make sure the borrower can't step in and stop this kind of sale. Another thing you might want to consider is called a deed in lieu of foreclosure. So in real estate transactions, this provision allows the borrower to transfer the property title directly to the lender, avoiding the lengthy and costly foreclosure process. So let's say you've got a borrower, they can't make the payments, they know they're going to have to forfeit and surrender the property, and they're willing to cooperate. And if you have strong communication with that borrower and they know they can't or won't continue making payments, a deed in lieu of foreclosure could be the most painless, seamless solution to resolving the issue. As long as they're willing to hand over the keys and forfeit their rights if and when that time comes, this is by far the fastest and easiest way for both parties to just move on. Now, this next one may or may not be relevant to you depending on what type of property you're dealing with, but it's called the assignment of rents and or the assignment of leases. And this is not the most common or necessary thing for most residential, non-income generating properties, but this could definitely be something to consider if you're selling an income-producing property to another business. And this type of document is usually separate from the mortgage or the note, and the purpose of this is to just enable the lender to collect income directly from whatever tenants are left in the building if the borrower stops paying. So when I worked in commercial banking, we always had our borrowers sign an assignment of rents and an assignment of leases. Why? Because we were lending to businesses that would be making money by leasing out part of the building, which was our collateral, to other tenants. So it made perfect sense to do this. But again, if you're dealing with a property that doesn't really generate income, then this probably isn't something you need to worry about. Another thing to think about is called step-in rights. So this is another item that makes a lot of sense, specifically when you're selling a property to a business, especially when it's a business that you know how to run. For example, let's say you owned a self-storage facility or a car wash and you sold the building and the business to someone with seller financing. And if that buyer/borrower quickly runs that business into the ground, step-in rights would give you as the lender the right to step back into the driver's seat and take over the operation or management of the collateral property to protect its value and ideally to make it continue generating income so the business itself isn't completely sabotaged by this. I've never used this one myself because I've never sold a business and a building together with seller financing, but if I ever did, I would definitely want to be sure this provision was included. Now, another very important thing to include is called the sale or transfer provisions, also known as the due on sale clause or the alienation clause, and this can restrict the borrower from selling or transferring the collateralized property without your consent as the lender. And the goal behind this clause is to just ensure that the lender maintains control over the key asset. And this clause is almost universally included in residential mortgages to ensure that the lender can assess and approve any new owner's creditworthiness before the collateral or the property changes hands. And this is particularly important for the lender because it helps them maintain the value and security of their collateral position. And lastly, governing law. In the unlikely event that there's a dispute between you and your borrower, if you have to go to court to resolve that issue, you'll want to make sure you can handle all of this on your home turf without having to fly across the country to wherever the property or your borrower is located. So, since I'm in Grand Rapids, Michigan, I would say within the state of Michigan, because that's what's convenient for me. But if you're located in some other state, then obviously put in the name of the state where you're at to make sure that any visits to the courthouse are convenient for you. When you add these terms as the seller in a seller finance deal, it's going to help you manage your risks better, keep control over the collateral, and have a lot of different ways to respond if a borrower ever defaults. And remember, make sure everything follows the law and is written clearly to avoid any legal issues. Be sure to talk to an attorney who knows what they're doing and has experience with seller financing and have them help you each step of the way. Thanks a lot for watching, and I'll talk to you again soon.